If anyone's having trouble with sound, just try turning your video off. So there's a button there with the video. Try turning that off. That may help with your sound. We're also going to record this and make it available if needs be. So if you do have problems with sound or video or anything, let us know and we can send you a copy of it. General disclaimer, everything we're talking about today is general in nature. It's not tailored to anyone individually with your circumstances or goals in mind. So if you've got any questions specific to yourself, please talk to your advisor, so Gil, Chris or myself, and we can talk to you about how these things may be relevant to your situation. And then I haven't updated this part of the slide and I've got Chris's details there as well. So I'll learn that for next time. Okay, a bit of an update on the market, and things have actually been quite positive over the last couple of weeks. So last week we saw the Australian share market up over 4.5% for the week. That's now got us up over 15% from the lows of about 2 weeks ago, 23rd of March. So I'm not going to definitively say that was the bottom of the market, but it definitely appears like we've had a strong bounce from there. And this is what we've been talking about all the way along. And what tends to happen in these periods is you have a sharp fall, but the first bounce tends to also be quite sharp as well. So, the message is always going to remain to stay in there. These things do recover, and we're seeing, what looks like the early signs of recovery already. We're still seeing a lot of volatility in the market. The market's moving, 3 to 5% daily. A normal day sort of before this kind of thing happened was maybe 0.5%. Now extremely common to see 3% plus. One day that I remember a couple of weeks ago, or it might be even 3 weeks ago now, middle of the day we were down 8%. By the end of the day we're up 4%. So sort of 12% swing just in the course of one day. But regularly we're seeing big movements from start to end of the day. And I don't think that's going anywhere anytime soon. There's still a fair bit of fear around in the economy, and where you get that sort of strong emotion, that's when we see these big movements. And I don't think that's going to go away in the next couple of months. Sometime in the next 3 to 6 months, I do think that will stabilise, and we're probably already seeing it a little bit now. But I think it's a while before we see market movements go back to the regularly to the smaller movements that we're used to. The main reason why we're seeing the market picking up at the moment is that new cases of the virus seem to be slowing down across the world. So that's giving the market a bit of optimism that perhaps this global shutdown that we're effectively dealing with may not be as prolonged as what we were expecting at the start, and that this whole thing may be more manageable than a lot of people were predicting. So that's giving a lot of optimism there. And I think there's also a case of we've basically had all the bad news that we can have. At some point, there's nothing more that can be announced that's going to send the market into panic. It's all factored in, and we're pretty close to that point now, I think. So now we're seeing most news that's coming out is being taken as some level of positive by the market, and that's again where we're seeing this bit of a bounce, and hopefully we see that continue for a while yet. Got a graph here that website that Gil found, which is quite interesting in terms of tracking the cases across the world. So it's got basically every country in the world on that website. I went through and just selected a few of what I thought were sort of the more key ones. And you can see that in all of those cases, the curve is starting to flatten. as they've been talking about in the media for a while, that we need to flatten the curve so that the health system can keep up, etc. You can see China there. We always have a bit of doubt about any figures out of China, but you can see China for the last month basically has had no new cases for the last couple of months, according to that chart there, basically flatlined. You can see South Korea has done something fairly similar. Australia is well and truly on the way to flatlining, according to this graph. Italy, which has obviously been one of the big problem areas, dramatically slowing down in their cases. Iran, who again was one of the big contributors early on, appear to be flattening there. Theirs isn't quite as obvious as some of the others, and potentially right at the end there's a little bit of an uptick again, but again, they seem to be flattening a lot from early on. And even the US, which has been one of the problem areas because they haven't taken a lot of the measures to slow things down, even the US appear to be slowing down now. So those things are really giving a lot of confidence in the market. Moving on. So our outlook going forward, really to see stability in the market, there's 4 areas that we need to watch. First one is a medical breakthrough. There's nothing tangible on the horizon yet. There's a fair few different things that they're trialling and have seen some sort of positives there. There may be something announced in the next couple of weeks through the results of some of the testing of various things that they're looking at. If we see a breakthrough there, then that's obviously going to be a huge positive for the market and for the world as a whole. Obviously, it's not going to be something overnight. Once they come up with some sort of vaccine or a treatment, they've still got to get that into production and get it out across the world. So it's still going to be a process to fix things. But we will definitely see a bounce in markets if we can see some sort of reliable treatment or vaccine. Another area that's going to help stabilise the market is policy response, so what governments are doing in response to this. And across the world, we've seen huge amounts of money pumped into the economy by governments to prop things up, and that appears to be continuing across the world. Almost daily there's new stimulus announced in various countries. Australia, we're having trouble keeping up with all the changes in policy because every day or every second day there's something new announced, and that's going to continue for some time. And basically all the governments across the world have pretty much said we've got an open checkbook and we're going to throw money at this until it goes away. And that gives us a lot of confidence that when we do return to some sort of normality, that we will see markets bounce quite strongly. We've still got this issue of oil in the background, which hasn't got a lot of attention because we've been very focused on the COVID-19 issue. But it does appear likely that there may be a deal between the Saudis and Russia, which will have oil prices up a bit higher, which is been one of the contributors to this downfall has been extremely low oil prices with the fight between the Saudis and Russia. But obviously with things slowing down so much across the world, people not driving to work, a lot of manufacturing basically stopping, the demand for oil is a lot lower. And so that in itself may keep the price low for a while. But again, any stability that we can get is going to be a good thing. The other area is confidence in health systems. So one of the big concerns with this virus has been that there's just going to be too many cases and health systems won't be able to cope with it. Across the world, and particularly in Australia, we're getting a lot of confidence that our health system is going to be able to cope with this. I saw just briefly this morning a headline because Newcastle Herald saying that they haven't really seen this pandemic hit yet. And, you know, they're still on high alert and ready to respond to it. But so far, the capacity in Australia hasn't really been strongly tested. So there's a lot of confidence there that our health system will be able to cope with this. So all of these things, while we may not have anything tangible in a medical breakthrough, we're getting strong policy response, oil is stabilising, and we are growing confidence in the health system. So all of those things are helping to stabilise our market now, and again, gives me a bit of confidence that perhaps we have seen the bottom of this. I'm definitely not going to make that call definitively yet, but you know, all the signs point to we may have seen the bottom of this already. Most of our clients would have seen this graph many times about how we manage your money when these things are happening. And our philosophy is very much that we want to have 1 to 2 years worth of the income that you're drawing out in cash and term deposits that are 100% safe, and then another 1 to 3 years in bond fixed interest type investments that are not as safe as cash, that will have a little bit of volatility, but in general will be very safe. And that gives you somewhere between 2 and 5 years worth of defensive assets there that you're drawing on before you have to worry about what shares and property, etc., are doing. And that's why, over the last few years, while things have been going well, we've been fairly diligent in taking profits out of your shares and property and topping up the defensive side, because it's been hard to do over the last couple of years because interest rates have been so low, and I know I've had a lot of questions from clients saying, oh, do we really need to put so much into cash when it's earning me 1% or less? And these are exactly the times that we do it for, because we can't see when these falls are going to happen. No one could predict that we're going to see a global pandemic this year. We've been talking for a while that we might see a bad year, but none of us thought it was going to be this that caused it, or it was going to be this sort of scale. And this is why we allocate those funds to the defensive side, so that we can ride out these bad times. And with how sharply this has fallen, we do expect that it will actually bounce back fairly sharply as well. But if you look at the worst case scenario that we've seen over the last 100 years, really was the global financial crisis. And in that, we saw the Australian market took about 5.5 years to be back in front. And that was the longest we've ever seen the market take to recover. And if you've got close to that 5 years worth of defensive that we're talking about, you've ridden out, maybe not quite the entirety of that fall, but you've ridden out the very worst of it, that's for sure. And really, even if you can have 1 to 2 years in defensive assets, you're going to get through the worst of any of these things. What you really want to avoid is having to sell anything down right now at a time when things have just fallen significantly. I forgot there was little arrows in here. Just thought I'd give you a bit of a sample of, we're seeing some horrible figures out of share markets of falls of 30-40% from the peak. The interesting thing though is when we're going through and reviewing clients and looking at their returns over the last 12 months, here's just a fairly typical client with about 50% of their money in shares and property and about 50% defensive. Over the last 12 months, their returns, they're down, but they're only down about 1.25%. So, and that's what we're sort of seeing at the moment, is a range from sort of -1 to -5, that kind of area. And you can see in here, there's a lot of their investments that are down quite strongly, down 20%, 18%, 19%. But the defensive side, because of the allocation there, they've got quite a bit of money that's, it's not earning huge amounts, but it's earning 1, 2, 3%, and that's helping stabilise those returns. And so we're not seeing anything like, the 20, minus 30 that markets have done over that time. So while this period has been scary, if you look at it over the 12-month period, it's negative, but it's nothing like what we've seen markets do over the last month. Okay, look at what the government's done since the last webinar that Chris did. Big things: the JobKEEPER payments, a couple more changes around Centrelink. So the JobKEEPER payment, which has been their big policy and probably the most expensive policy they're going to have over this period, is basically they're going to make a $1,500 a fortnight payment available to any business who retains an employee that they had on their books at 1st of March. So the way it's going to work is that the business has to pay every eligible employee at least $1,500 a fortnight, and then the government's going to pay the business in arrears for paying that. So regardless of what the employee was earning beforehand, the business has to pay them at least $1,500 a fortnight. So there's actually going to be quite a few part-time and casual employees that will get a boost in their pay through this. There will be others that are getting less, but at least they're getting a payment and they're staying attached to the business, so that when things do pick up, the business can put those staff straight back into work and things can hopefully return to normal quite quickly. So yeah, just to note there, it includes casuals where they've been with the employer for over 12 months. It also includes the business owners, so self-employed individuals that can be eligible for this, which is a really good thing. The payment's going to be made for up to 6 months, so this is going to be an extremely expensive initiative. First payments by the government are going to be made at the start of May, so businesses are are encouraged to start making those payments now, and they're going to be paid monthly in arrears starting 1st of May. To be eligible, employers with a business with a turnover of less than $1 billion, which is the majority, but there's obviously a lot of larger businesses with turnover over that, have to have a decrease in revenue of 30% or more basically over the last month. So it's got to be over a period of at least a month, starting from 1st of March. So basically, if you've had a 30% downturn in the month of March, then you're eligible to make this payment and receive payment from the government. If the employer has a turnover more than $1 billion, they've got to see a revenue decrease of 50% or more. The government's actually excluded the banks from this, regardless of any downturn. So they're expecting the banks to retain their employees regardless. The job seeker payment. So this is the payment made directly from the government to individuals, so not through the business. This is basically the dole or New Start. So a couple more tweaks that the government's done to this. They've relaxed the partner income test. So previously what we were seeing is a lot of people had lost their jobs, but their partner was still working. So they weren't eligible to claim this payment. So what the government's done is said if your partner's earning less than basically $80,000 a year, that you'll still be eligible for some job seeker payment. There will still be the normal income test on your personal income, and they've already suspended the asset test. So, you know, in theory, you could have $1 million worth of assets. They're only looking at the income that's producing, or the deemed income on that. So, yeah, I've got a note there, people with investment properties that perhaps they're not getting any rent on at the moment. That could be a real positive for them because that investment property is not going to preclude them from getting this payment. Working from home tax deductions. Anyone that logged in early knows that Gil added this and I wasn't aware of it until this morning. So basically what they're talking about here is if you're being forced to work from home, as a lot of us are, most of our business here is working from home now, and I know the vast majority of people where it's possible are working from home now. So what they're saying is that you're going to be eligible for an 80 cent per hour tax deduction. So if that's 40 hours a week, it's $32 a week you'd be eligible for. If it's from start of March right up until the end of financial year, which is looking reasonably likely at this stage, it could be up to about $550 tax deduction that you'd be eligible for. So we're not talking huge figures, but it's definitely something to be aware of, and something that any of us working from home should be making sure we claim at the end of financial year. They're encouraging us to keep a diary for everyday work, just to show that you were working from home and the hours that you were working. Okay, this is where I hand over to Gil, and he can give a bit of a spiel about recession versus depression. So how do you want me to do this, Gil?
There you go. Sorry, I muted myself, guys. Can you hear me still?
Yeah, I can hear you now.
Now, you should have the screen in front of you, do you? My screen? It says recession versus depression or not?
Don't have the presentation up now.
Okay, hold on. Here we go. How's that?
There we go. Got it up now.
Okay. So thank you very much, Steve. Ron, you've asked a very good question on expiring. There's a question there about whether casual employees such as school teachers are likely to receive the JobKeeper support. I would, whilst I can't say specifically to that question, I think we can assume fairly safely that all government employees are either going to keep their job or access the JobKeeper support payment. Now, the exact details of that, I would suggest that you could direct to the either the Centrelink websites or the to the HR department of the Department of Education. But I cannot imagine a scenario where the government is giving income support away to private employers but wouldn't match that same support for government employees such as school teachers.
Yeah, the interesting thing with the JobKeeper payment is it is purely up to the employer whether they choose to pay it and claim it. But yeah, as Gil said, I'd be very surprised if any government departments were taking advantage of that if they did, cut down hours or reduce things for staff.
Yeah, it would be stunning. It'll be difficult for them to reach that 30% reduction in income requirement. They're not a private business, but the whole point about this is the government is keeping the cash flow flowing in our society. Okay, what I wanted to talk about now is probably more going forward a month or two into what's going to appear in the media. There's certainly hints of it now in the discussion of, are we headed for a recession? Is that going to be a bad thing? And then I want to just go a little bit further and say, let's look at the word depression and try to identify whether there's something different here, which is, let's be honest, a global shutdown. Trade and employment has really, really been affected all around the world. And the last time anything like that happened is in the World Wars or in the actual Great Depression in the 20s and 30s. So I'm just going to visit history a little bit, and I hope this is relevant to everybody, but this is certainly where my mind goes when I start to say, okay, what are we up for? Let's do some research and find out if we're going to see something that we've seen before. So there's two words here that we see very regularly, the word recession, and perhaps less so, but I think we're going to see some language around this stuff over the next few months, and that's the word depression. I'm going to start by defining what a recession is. Effectively, it's a 6-month reduction in the national income. The gross domestic product is essentially the turnover of the entire nation, from the coffee cups right through to the wages paid to teachers, through to the exports of iron ore and gas. What a reduction means, though, is really quite simple. Last year I earned $100,000. This year I earned $99,000, and next year I only earned $98,500. Now, if you listen to the media reports, that's some form of financial disaster. for reality, it's actually just taking a deep breath and resetting things a little. It isn't ideal. However, it is by no means a financial disaster. This notion that the economy is going to take a pause. Now, for better or worse, Australia has been the envy of the world over the last 20 years, or 28 years, where we haven't had a recession of any kind, which means every single quarter our national income's crept up a little or a lot. Now, that, to a certain extent, is actually extremely difficult for any nation to sustain for a 25-year period, and Australia has done it. But the reason we've done it is essentially the reason why the depression conversation isn't likely to be a problem for us. So we'll go into there. Now, depression doesn't quite have the definition or the agreed definition of a recession, but basically it's a multi-year reduction in the national income and widespread unemployment. For the majority of cases, and we're looking back to the 1920s and 30s, it's a 10 to 20% reduction in the national income for many years. It normally involves massive closure of businesses, significant reduction in the value of items and properties and business turnover and government revenue. So I'm going to go now on a little bit of a history lesson. A lot of this data comes from the USA, but for reasons that I'll get to almost straight away, it actually extended all around the world. So all of this started in the roaring 20s. The stock markets were booming, employment were booming, trade was booming, everything was booming. To the point where the government in the US decided to slow things down by raising interest rates. Now, back then, the concept of a national economy, let alone international trade, was actually a relatively new idea. And they went too hard and went too fast. They raised interest rates too much, and it triggered a recession. Now, a recession in and of itself isn't necessarily a problem. It's sort of like the recession we had to have. But what actually happened was at the time there was a gold standard, which basically meant that interest rates and values of currency were linked to the value of the amount of gold that the country held in reserve. So every dollar issued by a government was backed up by gold in those days. Now, they found with international trade that they wanted to not move things too quickly. So all around the world, the value of the US dollar or the UK pound or the European currencies, they were all tightly linked by an agreement, which ultimately was undone in the 1940s at a place called Bretton Woods, where currency and gold were linked together. So when America and the European countries decided to slow things down, the linkage of currencies to each other triggered a recession all around the world. So after that, we started to look at the question, oh, were the banks safe? And we've had this question in this country in the last 10 years. So back in those days, banking was actually controlled at a state level, far less so than national. Now, at the time, confidence started to become undone or come undone. And so the banks started to fail. Now, the best way to think of it is to look at a US bank as being the equivalent of, say, the Maitland Mutual Building Society or credit union. The banks in the US were far smaller than they are today. And I think the best way to understand is if you're a fan of what's that great Christmas movie with Kate, what's the name of the Christmas movie?
I don't know.
No, it's the one where
It's a Wonderful Life.
It's a Wonderful Life, where it was, I think, Such and Such Savings and Loan was basically a bank was held at a small town level. Now, in the US at that time, they took the view that these banks weren't particularly strong. So the American economic situation being fairly brutal said, well, let them fail. If they're not good enough, if their small savings and loans organisations aren't strong enough, let them fail. And it was called a liquidationist policy. Now, what it did was it terrified everybody, and they took the money out of the banks. And the amount of money circulating in the economy dropped by 30%. So if you remember back to the webinar we gave a couple of weeks ago, where I talked about money supply, every dollar printed is meant to go around 7 times before it's worn out. And money dropped by a factor of 30%, forcing a 30% drop in the national income, forcing a 30% drop in employment, wages, and the value of properties and goods. And the whole thing here triggered a mass unemployment and business closure problem, otherwise known as the Great Depression. And the government didn't act. The government didn't act in America, it didn't act in Europe, and it didn't act in Australia because they didn't understand the way the capitalist economy worked. So it took several years to work through this problem. So the US created a policy known as protectionist policy. People may, if you're a student of history, have heard of Smoot-Hawley. It started with Ford McCumber, but basically these were tariffs that they brought in place to protect the US farmers in the early days because they were amongst the first hurt. And what they ended up doing over a course of 5 years is to create trade barriers in almost 300 different industries. In other words, it was the Great Wall of America, and it killed trade overnight, right? The amount of world trade dropped by 66% in that period. It was a staggeringly stupid thing to do, which is why in the last year or two, you've seen Donald Trump come under pressure because he's wanted to bring up trade barriers again to make America great again. But what he actually did was bring trade barriers against one nation in particular and create open or free trade arrangements with friends of America. Now, in the 1930s, this was all running in a complete mess. There were banks closing everywhere. People weren't confident their money was safe. They were losing their jobs. Businesses were closing. Jobs were going everywhere. The government released a bit of money, then took it back. It raised interest rates. It dropped interest rates. It was completely bad leadership at the time. Now, to be fair, no one had ever had to try to solve this problem before. So they would really, there was a lot of debate in the political and academic spheres about how to handle this, but all it did was create fear. And in 1933, there was a month-long run on the banks where people just took all the money out of the banks. The banks didn't have any money, and so that's where the It's a Wonderful Life kind of story happens, if you remember that movie. Now, what happened? There's a gentleman named Franklin Delano Roosevelt, FDR, created a banking holiday in 1933, so he shut all the banks for a week. And he said, that's it, you can't take your money out, frozen funds, right? Then he provided the same guarantee that Kevin Rudd did in 2007 and provided a bank deposit guarantee. So your money was safe with the banks because the government guaranteed it, and everybody brought their money back immediately and put it back in the banks over the following weeks. Then in 1934, he introduced a Reciprocal Tariff Act, which meant that if you want to have a free trade agreement with America, we will have if you lower your barriers with America, we will lower our barriers. The Americans will lower their barriers with you. And effectively, it restarted world trade. Now, having substantially suppressed world trade for 4 or 5 years, it didn't happen overnight. But over the course of the next 5 years leading up to World War II, it did happen. So the lessons that we learned from the Great Depression, and this is why I have a high degree of confidence we're not going to get it now, is that the government needs to be quick, it needs to be firm, and it needs to not dither. And that's exactly what we saw out of Australia this time around. We actually didn't see it out of America quite as much, which is why I think that they're going to suffer a little bit more than us. This government, for better or worse, whether you're a Liberal or Labor voter, acted quickly and fairly positively. Could they have done more? Possibly. Could they have done something different? Possibly. But the one thing they didn't do was fail to act. The banking sector needs to be 100% safe. So I can say with as much confidence as I can muster that the government in this country will not allow our banking sector to suffer. They will provide guarantees for every single investor. And if there's any question marks, the government will step up and guarantee the banking system. Now, the banking system in this country is instrumental in allowing business to run, in allowing people to buy wages. You do all your banking via FPOS. We couldn't really have a run on the banks if we wanted to at the moment because we couldn't get money out of them. They don't have enough. I don't know if anyone's heard me say this before, but of all the US dollars ever issued by the government, 92% have never been printed. Or to put it another way, 8% of all the American currency exists as hard currency and notes and coins. 92% of it's electronic. So we couldn't have a run on the banks and take all the money out even if we wanted to. Back in the 30s, it was the only way to have currency. You needed the banknote. These days, the majority of our currency is electronic. So the most important thing that we need to do is to keep the money flowing. And again, if you look at what the government did, the first thing they did was to create wage continuity for people. And they gave it to the people that are going to need it, which is the ones losing jobs or on the dole and things like that. For most of you, you are in your pension phase of your life. They haven't given pensioners anywhere near as much money as they've given people with families and mortgages and kids and so forth, because to be blunt, you're only going to save it. You don't need to spend it. We can't even go out at the moment, so there's not as much value in giving money to someone that doesn't need to buy groceries this week because they've already got plenty in the bank. So what they've done is they've given it to young families, and they've given it to people with mortgages, and they've given it to people that need the cash flow. So they keep the money flowing around the economy. The gold standard, now this is an important thing to understand, was dropped in 1944. Back then, if you issued a dollar, you had to have $1 worth of gold. Right? Now, what they found was it was actually a constraint on the growth of the economy. You couldn't grow the economy if you didn't have enough gold. So they introduced something called the Real Bills Act at the time, was another way of saying, all right, if you issue a dollar, you've got to have $1 worth of debt backing it up. But they found that didn't work as well. So what they actually did was to float the various currencies around the world. The companies and the economies of the world need to be nimble, open, and trading with each other. That is exactly the opposite of what happened in the 1930s. So in this country, I don't know if you've been aware of it, there's no conversation about trade barriers. There's no conversation about preventing foreign investment. There's no conversation about saying we need to return manufacturing to Australia, because the minute you do that, you start to reproduce the problems of the 1930s, and trade slows down and jobs slow down and everything slows down. So our company and our countries, companies in our country need to be relatively light-footed and able to set policy. So this is where the government provides wage increases or tax cuts. They provide incentives. They actually go and they build roads and bridges and trains and internets and things like that. And that's the best way to respond to this. I actually do have a question mark about the EU, because the EU, you're not allowed to change tax policy in France unless Germany approves and things like that. Now, there's already a move in the EU to allow the individual economies to respond by government stimulus, tax cuts and things like that. I think you're going to find a loosening of the bureaucracy in Europe. And I think that's going to be something, given the size of the European economy, that's actually going to be a very positive thing. But you cannot have an 800-pound elephant trying to steer a go-kart. It just doesn't work. And curiously enough, I think we're going to see a very interesting little experiment here. The cure for lack of money is quite simply to give people money. So up until now in our world, we've basically said, well, we'll give you $1, but you've got to go and look for a job. You know, we're not just going to give you money to stay at home. But there's starting to be, this is going to be one of the world's biggest experiments where they simply issue money to people that haven't earned it. And they're going to find, I think, because there's been a lot of studies on this, I don't know if anyone's heard of a concept called the universal basic income or universal wage, where the notion is that it's actually cheaper for a country to give everybody $15,000 or $20,000 a year in income, because what happens is they take the income and they go and they spend it. Whereas the current restriction that people have when the government gives you money is that they will take it off you almost as quickly as they give it to you when you go out and get a job. The concept of a universal basic income is we're just going to give you the money anyway, and we're going to hope you spend it. And when they do that, you're going to find that crime rates drop. You're going to find that people actually have a bit of optimism because they've got a cash flow coming in, so they don't sit there and hoard it. They actually spend it and go and educate their children and encourage people to look to the future. So quite simply, right now, the most important and effective thing the governments could have done was to issue money into the economy. It's called quantitative easing, where they basically print it. It isn't backed by gold. It isn't backed by any form of debt. It's certainly happening in America and Europe right now, in the UK. It will be happening here in Australia. I don't think we have much choice about it. It's better that you don't have to issue money to keep it flowing, but it's better to keep it flowing than it is to not have it flow, because that was what happened in the 20s and 30s. So for all these reasons, I actually have a fairly high degree of confidence, and I mean an extremely high degree of confidence, that the chance of a depression coming as a result of this world shutdown is actually quite remote. because the government is doing, or the governments of the world are doing everything opposite to what they were doing before. So at this point, sorry, I'm just looking at the questions. I actually agree with Steve quite strongly that we're seeing the early stage of a recovery here. It's going to be strange. I don't think there's any doubt about it. But for most retirees, the question is, will my investments hold their own or will they recover? And I think as much as my education can look at this, the answer is yes. I expect they're going to recover substantially from the falls they've had. Now, Mitzi's asked a question here. There was talk this morning on television about banks perhaps freezing their interest payments. Now, there's two ways to look at that. Are they going to freeze the interest rates or lower the interest rates? Well, they can't lower them much more. I very much doubt that they're going to stop people from being able to get their money. The one thing the government won't do is to freeze the bank accounts. If they freeze bank accounts, it terrifies people, and then you start a run on the banks. So they're going to do everything they can to guarantee cash flow through the banks. They're talking about freezing interest payments on mortgages. At the moment, what the government has talked about is giving mortgage holders, people that owe money on their house, a 6-month holiday from paying their mortgage. Now, up until now, I believe what they've said is we're just going to give the banks the ability to not ask for their mortgage holders to pay interest or a home loan repayment. I haven't heard anything from the government that they are going to pay the interest for the mortgage holder, although there may be some sort of initiative like that. So most retirees don't have mortgages. Most retirees aren't likely to receive a mortgage holiday. Most retirees aren't earning much on their bank accounts anyway. But I'd be very, so effectively they've cut the interest rates now. Most people are lucky to see a 1% term deposit rate. All that question might be referring to is the possibility that the bank's cash flow from the mortgage, the interest they're getting on their mortgages and their credit cards, is that enough to allow them to pay retirees? I'd be surprised if they freeze interest payments on term deposits, because it would be so much easier to simply issue a bit more capital and lend it to the banks. The question is, this is always a moving feast, Smithy, but I don't think they're likely to, they're certainly not going to freeze bank accounts. And I'd be surprised if they stop the payment of interest, because they haven't stopped the payment of mortgages, which is going to be something that is far more an issue. Although that's only it's an interest holiday only mortgage. They may give banks the ability to defer interest payments for 6 months in line with the mortgages. But to be honest, I haven't heard that question before, so it'll be a watch this space. Okay, so back to our slides. What are our thoughts on things? If the government gives you money, believe it or not, go out and spend it. I know a lot of my clients are helping their children at this time, and that's the right thing to do. I think as a country, we need to recognise that the economy needs to keep ticking over. Stay invested where possible. Recovery is likely, as Steve was talking about. It's actually happening, and your portfolio has been built to withstand this. At the moment, most of our clients are down single digits, somewhere between, as Steve said, 1% and about, I've seen 6 or 7 at the top end. For the younger clients, we're definitely seeing 12s and 15s, but for all our retiree clients, it's definitely under 10%. There's a negative return. The majority of it's in the 1, 2, 3, 4 sort of % negative, which is, just to be blunt, it's a fairly normal bad year. As I said, some signs of recovery are already happening. So most of us at Lower Hunter are working from home, but our offices still are open. So the Maitland office is open, the Katara office is open, and the Lambton office is open, either by arrangement or there'll be someone there. But the vast majority of our clients have been happy to deal with us via the telephone. So the majority of our conversations with you are happening via Zoom or the telephone. If there is a need for you to get money in a hurry, we absolutely have the offices open. We'll observe the standard social distancing rules that the government wants us to, so there'll be no handshakes or hugs. But business is still ticking along. We are definitely open for business. We're available on the phone. We're available over the computer, and if needs be, we're available in person. So I think that just about brings us to the end of today's session. If anyone has any questions, please put them up now. But Steve, thank you very much for your time, and it's been nicely attended. We have quite a few people on today's session, so I'm hoping these things have value. If you have any feedback for us, if you've got any questions or you feel that we need to address anything else, please please send me an email or give us a ring. I hope you're finding value in this. At this point, we intend to continue these sessions every week until this strange time is over. I do hope everyone's enjoyed it today. So thank you very much, and take care. Stay home, be safe, and give us a ring or an email if you need to talk with us. So no more questions coming in. So I'll say adieu to everybody. Take care. God bless.
Thanks, everybody.
So Steve, there was a question there for Ralph Francis from you. Are you there, Steve?